Hello, everybody. Welcome to Your Bread and Butter podcast. I'm Andrew Boudry.
And I'm Ryan Cummings.
Today, we're going to be looking at the value of a financial advisor, Cinderella pumpkin or a parachute. And by the way, do you know where a dog puts his money?
I don't. Where?
He makes a deposit. See you soon.
Okay.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer. Member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Private Financial Design LLC are not affiliated.
Bread and butter.
Welcome back, everyone. Today's episode in finding the value of a financial advisor, we're going to be discussing what are the things that a financial advisor actually does. And for any people out there wondering if it's valuable to have a financial advisor, today's podcast will hopefully answer some of those questions.
That's why we're entitling it Cinderella Pumpkin or a Parachute, because when the clock strikes midnight on your financial plan, will your wealth carriage turn into a pumpkin? Or will your advisor hand you a parachute? So glad that you're listening to us today, but this is a really big question that's out there, especially the value. Because is it financial advisor magic, or is it marketing, or is it a must-have?
Yeah, I think some of the opinions of financial advisors these days is, well, they're just helping me with my investing.
Right.
And there's much more to it than that. There's much more value add. You'll actually see when we'll look at some studies that are done by other companies and whatnot to kind of back some of what we're talking about here today. But there's a lot of value add in a lot of other areas, and especially the emotional side. And when you kind of combine a lot of the online, TikTok financial gurus these days, or YouTube gurus, or even just your standard robo-advisors who do investing for you. A lot of people say, well, maybe I could just do that, do it myself, or use a robo-advisor. Mm-hmm. But again, there's a lot more detail that we'll get into today, that these other methods of DIYs, maybe they're good for some people, but they don't cover every area that a financial advisor might.
Right.
At least a good one.
And most of our listeners are probably familiar with the Cinderella story and the whole idea of the, pumpkin being turned into this beautiful carriage, and at midnight, she loses her slipper and the carriage turns back into a pumpkin. Our idea here today is to actually make sure that you have a parachute. The idea that when you pack it, and then when you're ready to pull the ripcord, it actually opens and you land safely where you wanted to be. So we do want to have some data in front of us to talk a little bit about this.
Yeah, the one study we'll be quoting a little bit here today was a very interesting Russell Investment study called The Value of an Advisor. And they actually quantified the value that an advisor adds, hence the name of the study, at about 4.87%. So we're not going to dive into all the mechanics of that, but you'll see us quote some of those statistics of where that 4.87% comes from. And I think the big takeaway from it is not so much the exact number, but what are the key areas that advisors add more value and add some value, but maybe not as much.
Right. It may not be for everybody. There might be people that are financially astute out there and love juggling all the balls of their career and family and hobbies and all that, and still take care of all of their needs for planning, because it goes far beyond just the rate of return. But if you're talking about close to a 5% rate of return annually, that means over 20 years, you would actually have a 100% recoup on any assets that are, as far as like the expenses of doing everything.
Right.
If you're adding that much value in 20 years' time, you're back to square, as far as that goes, as far as 100%. So let's talk a little bit about the Cinderella pumpkin view. And let's start with the idea that an advisor's value is just simply temporary or exaggerated.
Yeah, I think as we already kind of alluded to, some of the sentiment around advisors, at least in some circles, is, investing has become easier these days. And if all the advisor is doing is investing for you, are they beating the market? Are they beating what you could have done? And that's a very small piece of the conversation. And if that is your focus when you're looking at an advisor, it may seem more like the pumpkin and when you're looking at the value that the advisor might add, because you might be thinking, well, if I go get a robo-advisor or I just stock my money in the S&P 500, can I do the same thing they're doing? But when you look at the actual benefits or help that an advisor can provide with asset allocation, there's a little more to be had there as far as the value and advice.
And there's definitely been a rise in the self-directed and investing and the influencer finance on the online, and there can be some good ideas out there. I mean, I watch some of these just to kind of see what's going on out there, but here's the catch. Many self-directed investors keep about 20% of their portfolio in cash, which is a costly drag in returns, which reminds me, by the way, do you know where a penguin keeps his money?
I don't.
In the snowbank, where it gets cold and doesn't do anything.
Well, that reminds me. Do you know what you call a pile of wet cash?
No.
Liquid assets.
Well, you'd have to wring them out, get the liquid. Yeah. Well, I think the advisors, by contrast, have a little bit more influence on that. So let's talk about that.
Yeah, with smart asset allocation and just getting that added advice from an advisor, one, to maybe help advise on how much cash should you be keeping, because like you just quoted in that statistic, a lot of people keep far too much in cash, and that's overall doesn't feel like it, but can be a drag on your net worth's total returns. But when you get also the smart side of proper diversification, where you have some fixed income investments, you have some international investments, you're not just in something like the S&P 500, because even though, yes, it's done well over the last decade and a half, there are decades, for example, we go back to the 2010 decade where the S&P 500 returned under 2% per year. And having proper diversification, other investments mixed in, can enhance that sort of return. So that value in that study that we're quoting here, the Russell Investments one, added about 0.3%. So it's not maybe a huge value that some people think, but it is some to add that exit asset.
Again, over 10 years, you're talking about a full 3% greater rate of return to you just by the diversification principle. But there's a side here that you can't really quantify, and that is, most of the job of an advisor is preventing the client from doing harm to themselves. And I think diversification that enhances the volatility factor and keeps somebody comfortable so they don't start pulling money out when they shouldn't be pulling money out. The other part of that too, which is really hard to put quantification on, is knowing and understanding when a time frame exists where they might need the cash. And so when you need the cash and you've got a time frame, your advisor can actually help plan that out for you so that you're not just lopping money out of the market at the worst possible time. And work a plan to get those all together. I mean, let's talk a little bit about how these do-it-yourself advice people handled the real big crashes that we've had recently in the last 10 years.
Yeah, I think we try to talk about that concept with our clients all the time, in the sense that when you just invest money in the market, let's say it's not even in a retirement account, that money's not really restricted in any way. The only quote-unquote restriction, as you just alluded to, is you may not want to pull out of the market at certain times. So investing 101 is buy low, sell high. If the market's down and you're pulling money out, well, you're not selling high, you're selling low. So an example of that is, you'd say of a DIY investor maybe followed some TikTok advice back in 2019, early 2020, and it sold everything at the bottom of the COVID pandemic crash. I had even family members that back at the beginning of COVID were, discussing, should we pull our money out of the market? Like, the market's crashing, it's going to go down further. And, my thought at that time was, yeah, it could go down further, sure. But there doesn't seem to be, other than reaction to the pandemic, there doesn't seem to be, physically mechanical issues wrong with the economy at the time. And so I was skeptical, and lo and behold, the market bounced back. And by the end of 2020, from its trough, the bottom to its peak, if you pulled out of the market at the time, you missed a 63% market rebound, a return on that year from the bottom of the low. If we're talking about the lowest low of the S&P to the peak of the S&P, a 63% gain over that period.
Yeah, and any decent advisor that is really working within a person's plan, depending on their personal needs, if they weren't really in need of the cash, then advising them to be patient, retool the market situation where they're at, calm them down, because truthfully, when the market goes down like that, everything goes with it. Everything
Right.
goes with it. But when it recovers, not everything recovers at the same rate. And that's where the portfolio diversification and switching to those assets would really matter to somebody to be able to recover at least as much as what the recovery is going to be. And on top of that, people who are in a position where they need the liquidity, it should have been taken care of long before the crash. So in other words, there should have been a plan in place for the liquidity needs. They may not have had to do it. So they might have saved on advisory fees by pulling into cash and not paying anything on it, but they lost a lot of money on the growth that occurred after that. So how do you look at this?
Yeah, I think it's not always about returns. Like you said, it's about kind of managing through the downtimes and the crashes too. And, if you're that investor, and we have to have this conversation sometimes, even with some of our clients from time to time, if you're that investor who's just chasing the upside of things, especially when the market's good multiple years in a row, you can sometimes lose sight of, well, what I'm doing is not just, profiting me in the up times, but in the good times, but also in those down times, it's going to be the protection and the shield, if you will, the parachute, and not just the fairy tale Cinderella pumpkin.
Yeah. So I think that's the thing that happens with people. I think a lot of times they think, well, I'll just buy in when the market starts to recover. But by then, you've already missed out on the upside, whereas the parachute is providing you protection. And one of the bottom line things that any good advisor is going to do for their clients is they're going to be able to describe to them whatever's happening in the market. And the truth is that the stock market, the bond market, all of our banking system is at the center of what America is about, its financial net worth, its financial actions. So it's not going to go away. It's not going to just disappear. And so that is part of everything we do. As you can tell right now, our government as we're filming this, our government's going through a shutdown phase. So what's going to happen? Well, eventually it's going to get repaired. Eventually it has to work. The people of this country will demand that our government works for them. So pumpkin or parachute? The advisor in this instance would be the parachute, protecting you on the way down.
Right. And I think that even on the government shutdown topic, I think that even speaks to the kind of the parachute side of things and protecting people from making that sort of irrational decision. Because if you were, for example, someone who maybe saw the government shutdown coming, it was pretty obvious that it was coming as we got to the end of September, or end of October, I should say, and or end of September. And that being said, if you were someone who was maybe afraid of that, pulled your money out prior to the shutdown, well, the market has been a little bit up and down since then, but there hasn't been, say, a big crash that maybe that person might have been predicting.
Right. And so they've missed out on the growth in that time period since this all began. Not that anybody would predict that it would have grown, right? But the truth is, patience is the byword. So let's look at the parachute view of how this all unfolds.
Yeah, I think it's not always as glamorous to talk about the downside or the protection piece of it when you're talking about advising or investing. It's like you said, some people they focus on the returns, but and this is actually the biggest value add for an advisor is, helping people not jump out of the parachute too early. It's not, it's not like just retiring or changing careers or facing a market downturn. It's dealing with all of these different events and making sure that you're managing, whether it's a market downturn that we're talking a lot about already, or whether it's a big life event, a change in your lifestyle, a change in your career, managing all of these things as efficiently as possible. So that way you don't set yourself back with a big financial mistake.
Exactly. I mean, I think in our role, and I find this so true, and I actually just read an article in one of our journals from the Journal of Financial Planning talking about advisors have become more counselors on behavioral coaching for people when it comes to their career and their finances. We act as emotional shock absorbers when there is volatility in their personal life, business life, in the marketplace. We're acting as shock absorbers, being able to take on some of that. I mean, investors who sold during past downturns, as you just talked about, you consistently miss out on the best rebound days because you never know when the rebound's going to occur. So we want to keep clients from, buying the assets high and then selling low and then getting hurt. And a conversation at the right moment literally can protect years and years of returns in a person's portfolio.
Yeah, I mean, even if you just look at someone like Warren Buffett, he talks about all the time is sell when people are greedy, buy when people are fearful. The natural inclination for an investor is when things are going well, you want to get your money in there and you don't want to miss out on the gains that everyone's realizing in the market. But that can often be the high point or the bad time to buy. And it's just the opposite. When the market's doing poorly, a lot of people are tempted to pull their money out, and being able to navigate that with an advisor is key. And to the tune of almost 2.5% from that study, if you talk about the value add there,
that's huge.
That's the biggest piece. So just kind of having your advisor act as that parachute and help you prevent you from making those mistakes.
Yes, and sometimes it's actually more about explaining and teaching the client as to what's actually going on and what's going on behind the scenes and how it impacts them. And I know some of our clients appreciate this. Sometimes they're not as happy or joyful about hearing it, but we talk a lot about how the global economy affects here in America. And with the current tariffs and all of that stuff going on, it's a more prescient topic because it's real. It's right here in front of us.
It is.
Seeing how connected we are to the rest of the world. And as we've talked about in some previous podcasts, we've had some reversal of this where actually global trade has expanded, not with America, but with other countries working with other countries. This actually could be a positive thing for the world global trading order, where people aren't as dependent on just China or the United States or even India, that there's a broader network now of global trade, which I actually think works well in the long run. So, I mean, I know we have clients that have gone through this, but we've had a number of clients in 2022. Let's talk a little bit about what happened in 2022. And the interest rates went up at an historical rate, and the market went historically down.
Right. Yeah. If you were invested just a few years ago, I mean, we saw the Fed hike rates an unprecedented amount of times in the 2022 year. It caused a bout of inflation that we are still kind of recovering through, and it caused the market to see 20-25% downturns that year. Well, just like whenever we see those sorts of downturns, people are tempted to pull their money out of the markets, and that's kind of our job to step in and calm those nerves. And essentially for those people that came to us with those fears, well, the market bounced back in about a year's time by the end of 2023. So it wasn't like this long drawn out recovery that took years and years or half a decade to bounce back from. It was 1 year's time, and the market was back to where it was. And now if you're still invested to this day, we're far beyond those highs from 2022 and 2023.
Yes, and we've had a number of people say to us in our meetings that time we talked, that time we had a phone call, or that time we met together was worth everything. All the money, returned back to me as so worth it. And that's just a conversation. So a parachute doesn't make you fly, but it helps you land safely. And that's what we're here for.
I think that's a great analogy, right? It's like we keep saying, it's not all about the returns. It's about not making those mistakes. It helps you land.
Exactly.
So this third segment here, we'll talk a little bit about the personalization that an advisor provides. So in the past, advisors were always thought about as just the investment person.
Stock pickers.
The stock picker. You're the investing guy. But today, like we've been kind of alluding to, you're a behavioral coach, a life planner, a career coach, and everything in between. If your advisor's adding proper value and doing a lot of these things.
Correct.
Don't get me wrong, some advisors may not do this stuff, but many do. And so that's where the kind of customized family wealth planning comes in. And if you hear the term, and it's kind of maybe overused a little bit in the financial word, but the term holistic planning. And that's alluding to, planning around someone's entire finances, not just the investments, but things like retirement, planning for your legacy, estate planning, charitable giving, having a family, buying a home, paying off debt. All those sorts of things encompassing having a customized financial plan that covers all of those areas. There's another about 1.13% in added value, again, from that study in returns to a client's overall net worth.
Yeah, it's not just about investing. It's about investing with meaning. Like, have you ever considered, I know you work out, you like working out. Have you ever considered, there's a reason why you would consider investing in a gym. Do you know why?
Why?
It would add some muscle to your portfolio.
It's true. That's true.
You have to personalize investing as to what people are comfortable with. And sometimes people actually can learn to be more comfortable with certain investments if they're taught properly, if they understand. I mean, we had a lot of older clients going back to 2022 where we talked about moving some of their portfolio out of bonds because the bond market was going to take a big hit. Even the midterm bonds. We knew the long-term bonds were going to take a hit, but so even some of those intermediate bonds were going to take a big hit. And so we talked to them about moving out of the bonds, which were their safety net, and going to stocks that were paying dividends, really good high-quality stocks that were paying dividends that would keep pace more with the rate increases as the dividend were increased by the corporate, by the shareholder, by the board. So we did that, but by educating them, we were able to move those portfolios in the right way for them to keep the income stream going in without watching their bond values falter, because in average that year, bond values went down almost 19%. So it was a really big, huge loss year for bonds. The income kept coming in, but as interest rates increased, the new bonds that are coming out now are at a higher interest rate. So it worked, switching them out from those portfolios. So it aligns your values, it aligns your generational wealth, it aligns even your charitable ambitions as to what you want to do after you're gone or even currently at this time. So
we've got some clients that want to avoid investing in the fossil fuel industry or firearms or military or all these specific things, and rather than just avoiding them altogether and perhaps having a lack of diversification in a portfolio, it's our role to be able to step in and help those clients invest with the meaning and the morality that they want to invest in, while at the same time not losing sight of proper diversification, proper allocation within their portfolios, and not taking on, say, undue risk just to avoid certain sectors or certain stocks.
And this personalized advice adds roughly about 1% in measurable value to a person's portfolio, according to the Russell study. And customization is what turns your portfolio actually into a plan, and a plan with a peace of mind that gives you the direction that you're wanting to do with the way you work. I mean, we all work hard, and there's tons of advertising out there, all these people wanting to take your money. A financial advisor shouldn't be interested in taking your money. If anything, they're worried about protecting your money and making sure that the value becomes more valuable to you.
Yeah, I always like to, even with a lot of our clients in discussions, I always like to, when we're talking through a plan, they have a question on something or wondering what to do, looking for some advice, and I always like to preface it by saying, well, here's maybe my recommendation, and admittedly, a lot of cases, and I try to always be cognizant of it, but I'm admittedly a little more numbers focused when it comes to these discussions. And I always try to say, well, here's my recommendation just based on maybe the facts and the numbers. But every financial decision is not just about numbers. It's also about emotion. And let's try to balance the two and get to the bottom of, well, how does this decision make you feel emotionally? And can we tweak that decision to make it align with your values a little bit more?
Exactly. I think as you measure the value of advice and you're wondering, well, is my advisor worth it? We'll give you a checklist here. I know that there's a company out there that advertises as being fiduciaries, which is a good thing to have a fiduciary in your financial life. And their tagline is, when you do better, we do better. So they're still charging your fees, but of course, as your account value goes up, they're getting paid more. And when your account value goes down, they get paid less. But that's the way it should be in a fiduciary relationship anyway. Right. So it's sort of like a common sense thing. It's not anything like very unique to anybody. But let's talk a little bit about a checklist that you can use to measure the value of advice, whether you're getting advice now or in the future.
Yeah, this is something that if you want to, we're just going to briefly touch on this checklist today, but if you want to really dive into these topics, actually tune into our next episode where we'll talk a little bit more about this. But you should be looking for things like, does your advisor educate you, not just sell products, not just sell insurance, not just sell annuities, things like that. Do they listen to you before giving out the recommendations to try to align your values with the advice they give? And are they very transparent about their fees and conflicts of interest? There's not something they're, hiding or having additional fees for providing additional services. Or if there is, they're at least, upfront about some of those fees.
Yes.
And then other things like, do they simplify your financial life, help you sleep better at night? Again, merge that value side of things. And then do they measure their success by the actual outcomes? Not just the performance of the portfolio, but are you actually achieving your goals? Are you actually making progress towards the things you want to accomplish?
Yeah, and a client can actually say something to the effect of, well, my advisor didn't beat the market because that was not really the goal, but they beat my anxiety. That's the kind of difference that you just can't chart.
Right.
Like, taking away that anxiety by giving them that peace of mind. It's not so much about getting a greater rate of return as giving a peace of mind that you're going to get where you want to be. I mean, if the advisor is adding roughly, just under 5% annually, the real payoff is the emotional stability that an advisor provides, as well as the financial stability in making that happen, making sure that there is some real balance there.
All those numbers, again, they're very quantitative, but I think the discussion is more qualitative. And looking at this big picture, what we talked about today, it's if you're focusing just on the investment returns, that was maybe a value add from an advisor, but it's one of the smaller pieces. When you're looking at the whole picture of what an advisor should be doing, that's where you're going to have, instead of that Cinderella pumpkin feeling where, maybe when the years are good, it feels all shiny and new and great and there's this magic going on because you're getting these great returns. But what happens when the market doesn't do that? Is your advisor also acting as that parachute? That's where you're really going to get, especially when we look at that study, you're going to get the biggest value adds from an advisor.
And if you're expecting magic that, all of a sudden, your world's just going to open up to this flourish of wealth, you're going to be disappointed. But if you value clarity, discipline, confidence when the market takes a shake, a good advisor is a parachute for you. A pumpkin, Cinderella pumpkin, looks impressive until you need to do something with it. A parachute looks a little bit bulky until you need it when the things are falling. And the real question is, which one are you carrying around? Are you looking for the magic, or are you looking for somebody to help you land safely where you want to be?
Yeah, that's a great point. So if today's episode gave you something to think about, learn a little bit more about what an advisor actually should be doing and the value they add, well, talk to your friends, maybe someone who has been working with an advisor. I'd also encourage you to listen to our next episode where we're going to get more into the details of what should you actually be looking for to make sure your advisor is adding this value and not just, managing your investments.
Absolutely. So, please subscribe to our podcast, leave a review, and remember, peace of mind is part of your portfolio. And remember, live today for the tomorrow that's in your heart.
Because you'll never have more time to invest for tomorrow than you do today.
Thank you for listening.
Bread and butter.